underway. Thank you for that. Good afternoon, everyone. Thank you for joining us today for our second quarter review and market outlook of 2025. My name is Mike Musio. I'm the president of FBB Capital Partners, and I'm joined by my colleague Mike Bailey, who, as you all know, is Director of Research and Chair of FBB's Investment Committee. And working behind the scenes with technology is our teammate Katie Bogley, who's doing a wonderful job as always. Today we'll review the second quarter of 2025. What a quarter it was. Started with Liberation Day, and we are a week away from Independence Day here, and a lot of activity I'm sure we'll get into in terms of the prepared comments, but also with some of the Q&A. So we're looking forward to get into that. We do have some questions that have been submitted in advance. Thank you for those who've participated there. Otherwise, you'll see a Q&A icon at the bottom of your Zoom screen. So we'll happy to address any questions to the extent we can on the fly, and certainly at the end of the prepared remarks. A couple of housekeeping items. You'll note that while you can see and hear us, as this is a Zoom webcast, attendees are going to remain in anonymous view only mode. As I said, the only exception there with the Q&A, I'll read the question, I'll read the name of the person or people who are asking a similar question, and we'll go from there. Finally, we will be recording the call today, which will be posted for replay on our website early next week. Actually should be early tomorrow. That recording has now begun. As we begin the discussion, let me remind you of the fact that today's commentary is based on the facts as we see them, which of course are ever changing. Please note that any reproduction or transcription of statements made during the call without our prior approval is prohibited. Should you know someone who you think would like to listen in, you can direct them to our website where they can find the recording, or you can have them contact us directly. Please note that all forward-looking statements made during the call are subject to risk and uncertainty that could cause actual results to differ materially from expectations and assumptions that we've discussed here today. Finally, please review at the end our complete compliance statement disclaimer at the end of the webcast, which Katie will throw on there. So with that, Mr. Bailey, I will turn it over to you.
Okay, thanks a lot, Mike. Today we'll touch on some of the geopolitical events that are increasing uncertainty for economic decision makers and investors. We'll then turn to how FBB is positioning as these macro events play out, and then wrap up with your questions. Next slide, please. So as we think about the first half of 2025, it's been a much more volatile year than last year, as new economic and social policies create significant changes. Also, as conflicts are emerging around the world. So today's webinar will walk through some of the ups and downs that we've seen, including an almost bear market and a sharp recovery as we look ahead to what's next. Next slide, please. So geopolitics. When investors think about geopolitics, many focus on things such as wars and natural disasters, terrorism, things like that. However, this category also includes major economic surprises, which could include things such as the tariffs that we're seeing this year. These tariffs could be impacting inflation as well as company earnings. Other policy changes out there are the reduced immigration that we're seeing that could impact labor markets and add to wage pressures. Additionally, some of the budget cuts that are proposed, as well as the government layoffs that are happening, could lead to localized recessions in parts of the country, including here in the DC area. Next slide, please. Okay, so moving from economic shocks to security concerns, we are seeing multiple conflicts around the world near major population centers as well as near energy resources. Many of these clashes have been ongoing for some time, but the most recent conflict in Iran has definitely surprised many. At this point, many investors seem to expect de-escalation in this conflict between Israel and Iran. However, we could see spillovers into such things as closed shipping lanes in the Middle East, or even a ratcheting back up of military engagement. So while it's too soon to know how this Iranian conflict will impact markets, a look back at history suggests that most of these geopolitical events tend to be short-lived, generally sort of a week or two, and tend to have a relatively minimal impact on markets, sort of in the 4 to 5% range in terms of impacting stocks. So we'll continue to monitor the Iranian conflict and its impact on the global economy and markets. Next slide, please. So with lots of emerging geopolitical events out there, the Federal Reserve is trying to forecast how these disparate forces will impact the economy. And as of last week's Fed meeting, things do look a little bit worse. Jay Powell's team expects that the economy will only grow about 1.4% this year, That's down from their prior estimate of something like 1.7%. That is slower than last year's growth of about 2.5%. So certainly a bit of a slowdown here. However, the Fed does see a bit of a short-term bounce in economic growth. There was a tough first quarter where there was a surge of imports coming into the country, trying to get ahead of some of those tariffs. Anytime you get a lot of imports, that tends to be a technical recession, holding all other forces unchanged. So again, the Fed does expect a recovery out of that. Other things that the Fed's looking at in terms of inflation, the Fed does see inflation running a little bit hotter, close to 3%. That one now, on one hand, it's below what we saw a few years ago. Inflation peaked at 9%. That was very brutal in calendar 22. But it's still above what the Fed's looking for in terms of a long-term goal of around 2%. In terms of the job market, the Fed does see a little bit of a worsening to around a 4.5% unemployment rate. That is a bit of a kind of loosening up of the job market relative to a couple of years ago where we had a sort of red hot demand for workers. Unemployment rate bottomed around 3.4%. So a few changes here, again, on the margin, things kind of slipping somewhat. But putting these together, what does all this mean for the economy and for interest rates? Let's turn to the next.
Mike, sorry, can we just go back here for a second? I think at the beginning or the very end of the GDP, you mentioned negative growth in the first quarter. I think you said technical recession. I think what you meant was a technical decline in GDP for one quarter. So could you just clarify that,
Yes,
please?
good catch. I appreciate that. Yeah, we're trying to pull a lot of data points here together, so that was a good catch. Yes, so I think what I was looking at was just a technical decline in GDP. So that was just one quarter. I think a lot of folks would expect 2 quarters in a row of declining GDP to be a recession. So that is a good catch. I think investors, sort of thinking back to where we were end of the first quarter, beginning of the second, we saw GDP declining. We also saw Liberation Day in early April. A lot of investors were saying, hey, wait a minute, now looking backwards, GDP is declining. Looking ahead, tariffs could lead to 2 quarters down. Fortunately, we haven't finished the second quarter, but it does look like we are going to see growth. So good catch. And again, we're likely to see relatively slow GDP growth this year. The year's not done yet. Certainly, we'll see what happens in the back half, but it seems like there's less odds of a full recession. So good catch there.
Good, thank you.
Right. So, we've talked about a lot of different things impacting the economy. I think as the Fed thinks about what's next, we are seeing sort of a bit of a slowdown, sort of the economy slipping somewhat. The Fed's in a bit of a tricky spot here for a couple of reasons. On one hand, we are seeing some tariffs that could heat up inflation, that could suggest keeping short-term rates at the relatively high level of about 4.5, which we've had since December. However, on the other hand, if tariffs and inflation lead to consumer pullback, layoffs, and maybe an actual recession, the Fed would likely cut rates to kind of speed up the economy. So overall, Jay Powell's comments over the last few weeks suggest more of a wait-and-see approach as these tariff policies evolve and gradually impact the economy. From a timing perspective, markets are betting that the current rates are going to hold until roughly September, when again, market expectations are for about a quarter-point rate cut at that point. So speaking of markets, let's now turn to a broader view of sentiment as investors project what's next for the economy and earnings. Next slide. Okay, so despite many of the unfolding surprises we've seen for geopolitics, markets appear to have rising confidence in stable growth in the U.S. To be fair, sentiment can be quite fickle, as we saw with equities, again, basically touching almost a bear market in early April after this wave of new tariffs threatened global growth. However, we've kind of flipped. We're basically in a new bull market with stocks up 20+%. Investors do anticipate an easing of these tariff risks and declining odds of a recession. So as we sort of move beyond this fairly bumpy first half of the year, let's take a look at some of the near-term catalysts that could start to impact the second half. Next slide. Okay, so we just showed that the U.S. stock market kind of jumped over a big hurdle the last couple of months in terms of tariff concerns in that first half. However, there are plenty of other events and data points that are going to be coming very quickly at investors that could also become barriers to kind of this view of steady growth. So as we're watching these conflicts in the Middle East unfold, at the same time, investors are going to also be getting a read on employment and inflation trends, again, relatively early in July. At the same time, also navigating a looming deadline for potential changes in tariff policies. So July 9th, certainly a big day, and a lot of investors are going to be watching that to see if there are any changes or decreases in some of those tariff proposals. We're also going to be entering another cycle of earnings in the back half of the month, and companies will be describing how they're navigating through some of these challenging geopolitical events. And finally, at the end of the month brings another update from Jay Powell on monetary policy. At this point, it does seem to be more likely continuity as opposed to change in terms of interest rate perspectives. So lots to chew on here as the U.S. economy enters the second half of the year. But now let's broaden the discussion to the rest of the world as we think about risk and opportunity. Next slide, please. Okay, so we just walked through some of the relatively modest challenges we're seeing in terms of U.S. economic growth. But what about some of the other markets out there? Some of the other developed economies that may get some help actually in the next couple of years through higher deficit spending. That's something the U.S. has done for some time, but we may see more of that outside the U.S. In particular, a defense buildup in Europe may be happening, and that could serve to increase some of the economic growth outside the U.S., as well as other markets may be decreasing their interest rates more quickly than what we're seeing here in the U.S. Putting some of these pieces together, anticipation of a relative growth improvement outside the U.S. could be, among some other forces, could be pushing down the dollar. That's had a sort of a related impact of adding to performance of foreign stocks this year. So if we think about that, take Europe, for example. If you look in local currency in euros, the European basket of stocks up about 8%. However, the weaker dollar is adding on to that. So if you're a U.S. investor owning Europe, it's up more like 20% year to date. So that does have a significant impact. And then finally, another angle on U.S. versus international is relative weightings. So if we were to take sort of a passive approach to owning all stocks in the world, it would be about 2/3 U.S., 1/3 rest of the world. However, investors have different approaches there. Some have an overweight position to the U.S. to the tune of, let's say, 80/20 or even 90/10. Some investors are reevaluating that geographic split in terms of weightings. And speaking of reevaluating, let's turn now to our positioning as we prepare for what's in store for the remainder of the year. Next slide. Okay, so for balanced portfolios, we continue to lock in bonds with interest rates that exceed inflation, both for corporate bonds and treasuries. From a quality perspective, we've been fortunate that several of our individual bonds have been upgraded by some of the ratings agencies. And that's in contrast to what we're seeing more broadly in the bond market, where there's a modest trend towards downgrades. So again, good to see that focus on quality. So as we're sort of working through on the bond side, balancing quality versus yield, let's turn to the next slide for a quick look at treasuries and some of the yield trends. So we take a quick look back here at the last decade for the treasury market. This is yields on 10-year treasuries. We're now paying a little over 4.25. We do continue to view that level of yield as attractive. Basically, we're getting yields above inflation, which is around 3%, and also well above the historical average. So again, a good alternative for folks who could be trimming a little bit on equities. There's a very nice alternative to own bonds with some attractive yields. Next slide, please. On the stock side, we continue to look for companies with the potential to meet or exceed investor expectations for profit growth. This continues to be a challenging task, for many investors, especially as tariffs are out there, a lot of uncertainty and worries over potential recession are lingering. However, we are finding these types of companies with durable growth, both in the U.S. and in other markets, and we'll get into that in the next slide. Okay, we touched on earlier that a weaker U.S. dollar is helping foreign stock performance, again, from a U.S. investor perspective. Let's kind of broaden that a little bit more and take a longer term view. If we go back 5 or even 10 or 15 years, the U.S. equities have generally outperformed rest of the world stocks, again, over that time period. However, this could be presenting an opportunity for us to reevaluate kind of U.S. versus international, potentially as we look at two different parts of the market, both having relatively mature growth, U.S. and other developed. However, we are seeing relatively attractive valuations outside the U.S. Compared to the U.S. market, where we are seeing stocks trade up against kind of higher relative valuations. So with that comparison, let's turn to our conclusion on the next slide. Right, so we're seeing this Middle East conflict play out here in the near term. It's something we're certainly highly focused on, and as well as other geopolitical factors that could impact the global economy, companies and markets as well. In general, we do expect companies to work through some of these challenges and adapt to tariffs and other policies as they navigate some of these geopolitical risks. We continue to seek out companies that can meet or exceed investor expectations, and with the goal of driving favorable long-term returns, both on the stock side as well as for bonds. And finally, as we think through these long-term total return goals in mind, we continue to recommend a fully invested allocation. So with that, we'll wrap up our prepared remarks and turn to your questions. Mike?
Thanks, Mike. So yeah, we try to keep the prepared stuff down to like 15, 20 minutes and then get into the good stuff, which is interactive Q&A. So if you missed us at the top of the webcast here, in the bottom of your toolbar for your Zoom window, you should see a Q&A box with a question mark. Just click that open, type in your question, and we will do our best to get to it here in the time we have left. Mike, this was a question that was sent in early and ahead of time, and I think it gets to the core of one of the two or three main questions of clients. I just wanted to go back and spend some time there. Linda, who I don't think is with us, but asks, what do you see tariff rates being for key countries like China, and will the tariffs contribute significantly to inflation? And that kind of ties in with some of Jay Powell's testimony and why he's, holding rates. And of course, President Trump has a very different position on where rates should be going. But I think the tie-in both on like the level, even though we've had like this pause, the level, and then like what that might mean for inflation. So that would be great.
Yeah, let's get into that. And again, we've had a lot of questions on tariffs, and so we've got a couple of charts here. I think, Katie, if we can flip to the last slide, I think it's appendix slide 20. We've got that. So it's a little bit of data packed into one slide here, but a couple different things to think about. Some of this data comes from Charles Schwab, and there's a third party called the Yale Budget Lab does a pretty good job putting together a lot of these tariff data points. So we'll take the question head on. So the first part was, what do you think about China? What will the final tariff be? You're taking a look at, again, this third party, I think they do a pretty good job. Their estimate is that this China tariff will be in the high 20s, 28, 29, something like that. Pretty significant, down from, I think, the initial, one of the goals, certainly in the high 40s, that sort of thing. So we'll see. This is definitely a moving target, but I think I would expect fairly significant tariffs on China. So we'll see how that plays out. One thing to think about, so moving from just one country that has that impact, the US, there are a couple different things that are moving around here. One is this idea of substitution. So if things are kind of status quo, we import a lot of things from China, there's a big tariff on China, prices in the US are likely to go up. However, there's this opportunity for US consumers to switch to things that come from other countries besides China. So that could sort of potentially lessen the blow of that inflationary force. So just flip side though, as we think about what is the overall impact, very, very tricky to tell. I think, a good gauge of that could be going back to Jay Powell and the Fed. So the Fed is projecting about 3% inflation by year end, sort of on an apples to apples basis. The way that they look at it, they calculate it as about 2.5% inflation right now. So from 2.5 to 3, it might not seem like a big deal, but at that very low level, that is fairly significant. So that I think is the Fed's best guess of all the different forces out there driving inflation. So it could be certainly well above or below that, but based on what we know now, that's a pretty good guess in terms of what we may see in terms of tariff related inflation.
Great. I think the second question with most frequency here is around obviously the what's happening now in the Middle East and the strike by the U.S. and Iran over the weekend, and maybe just spend a minute on these geopolitical events, specifically those that happen, in what would be considered a bear market with some historical context, Mike. You alluded to it on the front end, but duration, 2 weeks to 30 days out versus 6 months to 12 months out, how that typically plays out, please.
Yeah, so this is we're trying to pull together a lot of historical data. Every one of these events is a little bit different, whether it's a natural disaster, whether it's terrorism or war or something like that. So it is tough to just line them all up and say, okay, here's the average impact. However, we've seen a few data points out there. Folks have collected it. In general, if you were to go back to decades, many of these events it tends to be about 8 trading days roughly. So generally relatively short. That can range from pretty significant, 40 plus days, all the way down to just 1 or 2. So I think we're in, kind of within a 2-week period in terms of what's going on with Iran. So we'll see how that plays out. In terms of market impact, if you just line every event up, on average, it's been about a 4% decrease in terms of the U.S. stock market. Again, there's a big range there. Some 15% plus, and others, barely noticeable. So I guess the other piece is, how quickly do markets recover? So again, there's a big range there. However, on average, you can get this kind of 4%-ish decline in markets, and it does take, sort of a month plus, 30 to 40 days to get back to that prior level for markets. So kind of a range, but in general, these events, typically the ones that don't impact the economy globally on a long-term basis, tend to be short-lived, relatively modest impact, and kind of recover within, several weeks.
Okay, great. Couple of questions to get us to like U.S. and international valuation here. So I'm going to break these up, Mike. But Ronan asks, what do we assume the basis for the S&P price to earnings multiple or PE ratio being so high? And maybe just for context for people, we basically started the year at a forward multiple on the U.S. market of 22 times. We had a 20% correction from peak to trough into Liberation Day, and we've had a 22 or 23% recovery from there. And we're right back basically to 22 times earnings. So that's what Ronan is referring to. And again, for historical context, that's typically like 16, 15 to 17 times. So we are trading at a fairly rich multiple. Prices are not, uber expensive, but they're certainly full. So go ahead, Mike.
Exactly. I think that's a good way to frame it in terms of the way we're thinking about U.S. versus other markets. Some investors have said the U.S. market has been expensive for a long time. I think part of that is you have to sort of look under the hood and see what's in the U.S. market, what's driving it. For a number of years, really 10 plus years, it's been high growth sectors, tech primarily, consumer discretionary, communication services. So some of the Magnificent Seven type stocks used to be called the FANGs, et cetera. As those companies get really big and they continue to grow really quickly, investors have rewarded those companies with very high valuations, basically treating them as a premium, so the best house on the block. The U.S. has the biggest collection of those, and as you just put everything in the U.S. market together, line it up, that pushes the overall average up for the U.S. Valuations in terms of it looking expensive. So the question is, the U.S. at this point, you got these big high growth companies. Investors are treating it like a premium group. You've got other groups outside the U.S. that just really don't have that level of big companies and high growth. However, they're trading at more reasonable valuations relative to history. So, for example, other developed markets trading more about 15 times, 1.5. So that's sort of the debate. Do you buy growth, it's trading at a premium, or do you buy sort of a little bit more modest but yet durable growth, trading at a lower valuation, or can you do a little bit of both? And I think that's really the question: is what is that split? And then that goes back to the idea of weightings. U.S. about 2/3 of the world market, and then the rest of the world about a third. Certainly, investors are playing that split in different ways, but those are some of the opportunities at this point.
Okay, great. And then as a follow-on, Tim asks, is now a good time to shift away from U.S. equities toward international equities? We talked about that, the gap, and we talked about the year to date. Again, for some context, with the U.S. is trading at 22 times, international developed markets are trading at, let's call it 16 to 17 times.
Yeah, so it's I think for a little while, especially in early April, there was a sell America trade going on. A lot of the S&P was going down, other markets around the world going up. For folks who dumped the U.S. at that time, that's been kind of challenging because the U.S. has come roaring back. So I wouldn't want to think about it from a tactical perspective of all or nothing. You're in one market, you're out of another. I think it's really how do you want to diversify? So again, I go back to that passive approach would be 2/3 U.S., 1/3 international. A lot of U.S.-based investors have tended to overweight the U.S. Again, 80/20, 90/10, something like that. So putting those together, I think that there is an opportunity to own a little bit more international. Again, that's fairly steady growth. A couple of things working for them. They're doing a little bit more deficit spending. We talked about defense spending, interest rate declines maybe helping them out. Evaluations are fairly average in that group. So on the margin, as folks have cash or see some expensive U.S. stocks, there could be an opportunity to trim some of those and swap into international markets, trading at more of an average valuation.
Okay, and then sticking with international markets, David asks, In the changed Mideast environment, where Iran won't have the bomb and Abraham Accords may expand, you see investment opportunities in other Mideast countries, Saudi Arabia, Qatar, et cetera, or in products or sectors affected by the Middle East.
Yeah, so jumping into that, I think certainly a good question to ask. I think the Israeli market, I believe, is up pretty significantly this year. So you do see some of these emerging markets doing pretty well. Historically, they tend to be pretty volatile. So I think for us, we have to look at all the opportunities out there. The U.S. market, again, for the last 15 years has been very attractive, and I think there's a very reasonable chance for some pretty good growth ahead. So you have to compare other emerging markets, the risk and the return opportunity. I think going into something very specific, a relatively small market like the Middle East, it is a higher risk return opportunity. So maybe for folks with that type of risk appetite, there's something there. But I think in general, as we're thinking of, what are some good ways to help clients meet long-term retirement goals, that sort of thing. The U.S. market tends to offer pretty good opportunities. It's a little expensive right now, not terribly expensive, but I think between the U.S. and other developed markets, that's probably a better way to manage most of someone's kind of equity exposure. So again, there's certainly pockets of areas to get higher risk return outside the U.S. Emerging markets, again, tends to be a little tricky and pretty volatile at this point. So never say never, but certainly it's something where we want to think about balancing out that risk and return opportunity.
Yeah, and I would just add, David, that the most obvious trade would have been when, bombs were being dropped by us and over the last, dozen days or so, with the conflict between Israel and Iran would, for anybody, sector-wise would be oil. And anybody who went headlong into oil, and God forbid they did it on margin, they had their heads handed to them. So sometimes this stuff isn't as obvious as maybe it seems. Um,
And maybe Mike, just kind of adding to that, I think that's a great point in terms of one way to have exposure to a sector or commodity where there's certainly a lot of overlap in the Middle East. But yeah, owning some energy, I think that historically has been a relatively good hedge for inflation in general. So I think that's something that we would support. And however, avoiding that temptation to really pile into it, for a given event, but having some exposure, getting some dividends out of it, and using that as sort of a commodity or inflation hedge.
a couple questions here. I'll take these, Mike. Barbara and another attendee are asking questions about should we be worrying about the federal budget deficit and ongoing negotiations, and any thoughts on the impact of the big, beautiful bill. So negotiations there are ongoing in terms of the bill. Big picture, what's out there so far would be, continuing to add to the deficit to the tune of, $2 trillion-ish a year, which is very high by historical standards, particularly in a period of time where the economy is growing, not in a period of crisis. And this is kind of carry on spending from, the last 5 or 6 years through COVID. And, once Congress turns on the spigots, and it's really hard to turn them back off. And so a lot of these commitments, and non-discretionary spending is such a large, what was happening at that same time was interest rates were going up. So the amount of discretionary spending has decreased in percentage terms as the amount of non-discretionary spending, Social Security, Medicare, Medicaid, interest on the debt, has gone up. So whatever the ultimate plan is, continued deficits in fairly significant dollar amounts, as far as we can see. I think they were pushing for a $5 trillion increase as part of this, for the debt ceiling, which is also part of this negotiation, which would get us out well past the midterms, and into the latter part of the Trump administration. Nobody knows when those chickens come home to roost. If you look at other developed economies like Japan, it would indicate that there's a lot of room to run potentially. And there certainly does not seem to be any kind of appetite on the Hill for anybody in Congress to take a stand to either raise taxes or cut spending, or better yet, both meet in the middle somewhere. So we shall see, Barbara.
Maybe Mike, if I can add on to that, 'cause I do think that's a pretty significant question. I think we've talked about it on these calls, for over a number of years. One of the things, maybe just the themes that we look at often is behavioral finance. It's something we've kind of built into our process, and many investors tend to be fairly myopic. What's going to happen next quarter, or next year, but it's hard for many investors to extrapolate and say, how does this event today impact 5 or 10 years from now? So that's one issue where in some ways, additional deficit spending in the U.S. might be a good thing to near-term markets. So you've got that on one hand. The flip side is there's going to be there's a bill to pay, and so it's just really hard to know when that might happen. Maybe it makes the next recession tougher. So something to think about. I guess the other piece in terms of sort of a regulator on some of this stuff is the bond market. So we saw a couple of hiccups in the bond market where the government was said, hey, we're going to just start to get all this money for deficit spending. Bond market had a bit of a hiccup for a couple of days. If that hiccup becomes very significant and interest rates really start to move up, I think that's going to be a much bigger signal to the U.S. that really it's going to be tougher to continue this level of deficit spending. So we'll have to wait to see how that plays out.
I think from deficit spending and rising debt levels and dollar depreciation and interest rate markets in terms of fixed income kind of ties into a question we have from an attendee in terms of thoughts on physical gold or gold prices, which again we talked about oil as a commodity, gold, also certainly in that basket, but it's been a mover this year, Mike.
Yeah, absolutely. So, gold and other asset classes outside of traditional stocks and bonds, there are plenty of things out there, a lot of things to take a look at. So gold is one. Certainly, we have had a big move up this year. It's not something we've participated in a big way in the past. We're certainly always evaluating that, as a potential hedge. So, basically, kind of we'll see. We'll see how that plays out. But I think the issue for us with gold is there's a speculative piece to it. So it's gold is worth what someone else will pay, as opposed to some other asset classes that generate cash. Stocks generate income or dividends, bonds generate coupons, et cetera. So it is a little bit fickle, and interestingly, maybe not quite as much as with crypto, for example, but a lot of times these a little more speculative asset classes generate a lot of attention once they reach these new peaks. And a lot of times that's the moment to maybe hit pause and wait. So it could be the kind of thing, if there is a bit of a breather for gold, come back and take a look after folks have kind of moved on to something else. And that could be a really good time to own it. But we'll see. It certainly is another way. It is another hedge, maybe a complement to energy or commodities as well.
Great. Warren asks, can you add any depth to the effect of immigration restriction on the economy? I'll take a stab, Mike, and then feel free to add. So it's definitely like, so we talked last time we did one of these calls, the difference between soft and hard data or survey data versus hard data that's actually reported and collected for GDP or BLS statistics or something like that. It's not really showing up in the hard data as of yet. I mean, maybe a little bit in the employment participation rate, which gets reported, every month with from the BLS with the labor numbers. We'll get again the June number next week. Short trading week next week, only 3.5 days of trade, but we are going to get that number on the 3rd, I guess. So that would be something to kind of watch to see how that's going. On the flip side, the industries that would appear to be most impacted be the hospitality industries, home building industry, farming, and agriculture. Those folks are indicating already, and in fact, like they have petitioned Congress. And actually, I think it was early last week. There was a little back and forth on some of the deportation stuff in terms of potentially exempting some of these industries, and then no, we're not doing that. But you're starting to hear from those businesses for sure that things are a little bit tougher from a workforce standpoint than what it was. I personally think that's going to continue from a regional standpoint. Like that's going to be in terms of finding the employees, like that's likely to be kind of what we're experiencing in the DC region in terms of the impact of Doge. And so it'll be interesting to see how that kind of flows through to the markets, or excuse me, into the economy, into employment, and then eventually into prices, right? Particularly if you talk about, crops or hospitality. You don't have people to help in the hospitality industry or to pick the crops. You've got more limited supply, and that could, potentially lead to higher prices. So we will see. Mike, anything to add?
Yeah, one thing I might add, going back to sort of the timeline we put on one of our slides, I think to your point, Mike, yeah, we'll get a jobs number here in a few trading days early next week. The other thing to take a look at is earnings season, so kind of the back half of July. Companies in those industries, whether it's hotels, construction, restaurants, et cetera, they are going to start to flag these things. If they are seeing, just challenges finding people, you're going to see that either in difficulties there in hiring or higher wage pressures to hire other folks who are out there. So probably a month away from getting another read on what the actual impact is from some of the immigration declines.
Okay, great. Let's see. Going back to international for a second, can you give us an example? I'm going to combine a couple questions here. Can you give us an example of international companies or locations FBB is looking at? And then I guess within that context, an example of a position that we've recently picked up and what was the trigger to indicate that as a purchase? And we can stick with international as one question, Mike. Thanks.
Absolutely. So in terms of the international front, so at this point, for our portfolios of individual equities, we've got a couple international stocks in there. One is Taiwan Semiconductor. So that's a big holding for us. We've had it for some time. It's generating a lot of nice growth as far as the AI sort of theme. They're manufacturing a lot of the chips used for AI. Another international company, a similar part of that kind of food chain is ASML. It's based in Europe. So a couple names there. As we're looking at other things, there's certainly plenty of interesting companies out there that could be owned individually. I think the other approach is to own a basket. So that's kind of what we've been doing in the relatively recent past, is picking up a basket of developed international stocks. So that's another way of owning that. One thing, just as you sort of dig through, I mentioned the U.S. market has a lot of these really mega cap companies, higher growth in tech, for example. Rest of the world, it's a lot more diversified. So you're looking at the average company, a little bit slower growth, but a lot more in financials and banks and industrials, companies like that, and utilities and energy. So similar types of companies, but just a very different mix. But there certainly are a lot of companies out there. Again, we're kind of indifferent as to where they're headquartered, but if there's a business where they can exceed investor expectations and has a reasonable valuation, that's something we're looking for. So I would say stay tuned as we continue to look there.
Great. Tim asks, a question is, in response to rising federal deficits, what prospect do you see for mandatory cuts to Social Security, Medicare in 5 to 10 years? What impact will this have on the economy and the investing? Yes, so Tim, there was an updated report came out about 2 or so weeks ago, I think earlier this month, on Social Security. I think the previous target was 2034, 2035. Receipts would not cover outlays. It's the taxes that are being paid by active workers would not be adequate of the money coming in each year to then turn around and pay out to the individuals who are collecting. As the baby boomers and my own Gen Xers, approach or enter retirement, what's happening is there are fewer people working, right, for each retired person. The boomers were in there working, very productive in the 60s and 70s as the greatest generation was entering, the Social Security roles as benefits, and there were more of them, and so that was well supported. But that number started at like 10 to 1 back in the late 30s when Social Security started, and expected to be down to 2 and a fraction to 1. And so the number of working Americans paying in is declining. And then people are living longer, right? We're healthier, right? A 65-year-old today is healthier than a 65-year-old, all else being equal in 1936. So these are structural issues with the program in terms of the duration of the payouts. Medicare is a similar story. Both of these are, though, kind of addressable with some intestinal fortitude by Congress people, and maybe a ceasefire of Congress across the aisle would be a good place to start in terms of as we come up with ideas, silly as they may seem, restrictive as they may seem, aggressive as they may seem, we're not going to launch attack ads of showing people pushing granny off of the cliff. And we're not going to give press conferences about, killing Medicare and Social Security. We're just trying to get a bunch of potential solutions together to make sure that this system lasts for generations to come. And if maybe we start with a ceasefire, then they could get together, whiteboard this thing out and do some things that they did about 40 years ago in the middle of Reagan's second term, which was extend the retirement age. I don't think this would affect current retirees or people inside of, 10 years of retirement at all. The easiest thing with Social Security is just change the income level that the tax is collected. I think right now it's around 170,000 is the cap, and then we just don't collect that money from the employer or the employee anymore. And so instead of just indexing that, you could do a step up to where hey, if you make, $300,000 a year, $350,000 a year, you've got to pay. Maybe it could even be a declining schedule instead of 7.5% total Medicare, Medicaid. Maybe it declines, as you get a little bit on up in income, but that would pay more into the system. It's just the current structure of the pay as you go is not sustainable past, 8 or 9 more years. So there are parts of that in place already. That's how these two entitlement programs or two safety net programs were structured. The grenade is Medicaid. Medicaid is unequivocally the issue that is an unfunded liability. There is no tax structure that is paying for that system. I would argue that you can a good measure of how developed an economy is and a leader of economy is how those folks take care of the most underserved or weakest among us. So Medicaid is an absolute must, but there's got to be a structure to pay for it. You can't go from 40 million people enrolled in that system 15 years ago to 80 million today and not have it paid for, because what ends up happening is it just gets paid for by additional budget deficits, and that's what's happening right now. So Tim, that's the one that they all need to be addressed. The first two, I would argue, and Alan Greenspan and other very, very smart people have said it, time and time again, these things can be fixed when a bunch of smart people, get in a room for a couple hours and get it taken care of. So Medicaid, that's the question. So we will see. Sorry for the duration of that. Mike, anything to add?
I mean, the only thing I might add, I covered healthcare for a long time, and Medicaid, even Medicare, but I think Medicaid in particular, the government approach has been as a payer instead of a purchaser. And so they just kind of rubber stamp things and send money out, as opposed to some of that, structural change, and sort of treat some of these big, big medical entitlements almost like a private sector. How can we optimize and make this a really efficient way to help people out? So definitely is a heavy lift, but I think certainly possible to fix both of these.
Great. Okay, a couple more here, and we'll try to wrap up at a quarter till, so just a couple minutes. We have a question from Connor about government and Freddie Fannie discussion about crypto in terms of for I guess paying for mortgages. Maybe I think we're long time away from that. I still think crypto in general, well, maybe stable coins aside. Crypto in general, as a medium of exchange is problematic. So I haven't seen what the recent on a stable coin is, but that could be a little bit different. I have one person tell me to run for Congress, and somebody said stay away from Congress. So there you go. That's good. We kept it between the 40s. Okay, good. All right, last question. How or what thoughts are you considering for adjusting the portfolio and global instability and economic shifts in light of inflation, interest rate uncertainty, and elevated market valuations? It would seem policy uncertainty with a wide range of possible outcomes to manage risk and preserve real returns. That question comes from our buddy Brian, Mike. So What do you
Yeah,
think?
happy to take that on. I think it's a great question. Sort of encapsulates everything we talked about in the prepared remarks. A lot of challenges out there. A couple ways to tackle that. One, I think there's a human sort of response to sort of fight or flight, and in terms of the flight mechanism, if you were worried about inflation, unemployment, geopolitics, all these other things, tariffs, you may want to pull back from risk and go to bonds or go to cash, that sort of thing. Historically, that tends not to be the best move. Typically you do want to stick with your long-term allocations. So I think that's something to really keep in mind. However, looking a little more tactically, I think for folks who, let's say you're a 60-40 balanced portfolio and your stocks have had a nice run last couple months, you're a little bit over 60%. Now is a good time to trim some of that risk. And as we talked about, bonds are very attractive. You can park some of that money, earn 4 or 5%, and that's a great place to sort of compound your wealth over a number of years. So a couple ways to think about it, but as you probably go back and look at all of our webinars, there's always some type of risk factor that's emerging, and I think as we look at companies that are able to kind of navigate that, drive long-term growth, and a lot of times stock prices will chase some of that profit growth. That's really what we're looking for, so we would stick with that.
Yeah, and then the only thing that I would add to that is, if your portfolio is structured in a way, Brian and others that could support, in addition to the standard 60-40, something within the alternative asset class. And we've added some of this, right? For most clients, we've added a tactical opportunity fund that's run by BlackRock. It goes a little bit, can underweight, overweight, goes a little long, a little short, stocks, bonds, supposed to move like a bomb, but provide a diversifying effect to help effectuate real returns or protect in a period of downdraft. And then there are other, private investments that are available to some clients that we've had some conversations with that you. Some of these are probably risk reducers. They're definitively day-to-day return just kind of eveners because they don't price daily, right? So just like your house doesn't get a price every day, you might get an update from Zillow or Redfin or something once a month, but even that, like how real is that? But you know what the general trend is, and it seems a little bit more stable. Reality is, any given day, like your house could be one of the most volatile assets that you own. But in these private markets, they're not as beholden to the quarterly reporting cycle, right? These are companies you have institutional investors coming in, and we're really like, LPs or limited partners that are coming in to like, ride along and invest for hopefully that, good long-term returns and a little bit more stable of a ride. So, I think those have a place for some clients as well. Um, Um, all right. I said last one. I'll give it one more. What strategies considering looking at advising people to consider now while the current tax laws and exemptions are still in place to optimize long-term tax efficiency, legacy planning, i.e., if the big beautiful bill cannot pass? I don't know when the big beautiful bill is going to pass. I don't know if it's going to be called the big beautiful bill when it does pass, but I can tell you, having been down this road before in terms of fiscal cliff and um, the sequesters and all these things, it is highly unlikely to me that we enter January of 2026 without some type of agreement for either an extension for a period of time or of the tax rates or whatever. That said, if we were going down the path of thinking that, tax rates on average are going to be higher because we go back to that budget deficit conversation, and I were an investor, there's a lot of things that you might be considering doing now. You might be front loading large charitable contributions that you, from a legacy standpoint, that you have an idea or an inkling to make. You might be front loading some of those now in order to get additional room within the existing tax brackets, right? So, and in order to drop from 35 to 32 to 24, maybe you make bigger contributions. So that allows you actually to do something like, larger Roth conversions, or it allows you to realize more capital gains at today's 15% capital gains rates and really push on that if you think capital gains rates likely, I don't really care about like this year or next year, but if the trend 10 years from now is higher tax rates, you might be saying to FBB, hey, go ahead, realize more gains, reset my basis, reallocate like tax brackets on the capital gain side are at actually historic lows. Let's go ahead and take advantage while we know where it is. So those are a couple of examples of things. On the deduction side, there's just not much. I mean, because most clients, if you itemize, if still, which many do not itemize still, but if you do, it's $10,000 of tax right now. It's interest on a mortgage and it's medical expenses. If you qualify, that's still a really, really big threshold. And then charitable contributions. So, um, but yeah, I mean, conversations worth having in terms of your planning, no doubt. So, all right. We went 5 minutes later than I thought we would, but appreciate everybody sticking with us. Good of you all to attend. As we started the conversation, certainly a volatile quarter. Here's hoping that Q3 starts out a little bit less volatile than Q2 did. That said, as Mike showed that timeline, there's a lot of stuff happening in July, both on the fiscal front and on the monetary front. And then, of course, earnings season starts as well. And so we'll stay tuned, and if there's anything, broadly to communicate, we'll be sure to do that. And as always, if you have questions, please reach out directly to your advisor, your portfolio manager. They'd be happy to help. Thank you all for your continued trust and confidence in FBB Capital. We do not take it lightly. We appreciate it. We're here to serve you, and we thank you for the opportunity to do that. So, wishing you all a very happy 4th and a good summer, and thanks for joining us. Goodbye.